Okay, so if you've been watching the markets, I mean, really watching them this past year, you know the story. It's all about the AI gold rush.
Right. The narrative's been pretty simple, hasn't it? Just uh, seemingly endless demand for specialized computing power.
Exactly. And the idea was the companies renting out those super sought after Nvidia chips, the ones powering everything AI well, they were just going to print money. Easy.
Yeah. The assumption was cloud infrastructure for AI equals automatic high margins, a
Yeah.
profit machine.
A total profit machine. But then this one financial report landed kind of out of nowhere.
And it just cut right through all that hype. It put this really harsh spotlight, not on the revenue, which is huge, but on the actual cost,
Yeah.
the surprisingly thin margins involved.
And the market, well, it sort of freaked out. So our mission today is to unpack this specific piece of research. It's a deep dive into Oracle's cloud financials, apparently based on some internal documents cited by the information.
Yeah, we really need to understand why this one number, this low gross margin figure, caused such a tremor in the stock market.
And what it signals, about the real economics of renting out these high-demand NVIDIA servers. This is your shortcut to getting past the AI hype and looking at the financial reality underneath. Let's dive right in. The number that really hit Wall Street and kicked off the selling. According to this internal data, Oracle's revenue just from renting NVIDIA-powered servers, the core AI bit, was around $900 million in the latest period.
900 million sounds great on the surface, right?
Yeah,
Massive number.
absolutely.
But here's the rub. Here's the financial challenge, as the source put it. That $900 million in revenue, it only generated about 125 million in gross profit.
Okay, wait. 125 million from $900 million.
Mm-hmm. And you do the math, which, believe me, every analyst did instantly.
Mhm.
And that comes out to, well, a really slim 14% gross margin for that specific high-demand AI segment.
14%. Wow, that is thin. Can we just clarify gross margin here? Are we talking profit after you account for the giant costs of, running these massive data centers? Power, cooling, the chips themselves?
Yeah, essentially. Gross margin here is your revenue minus the direct cost of delivering that service. So it definitely includes things like the depreciation on those incredibly expensive NVIDIA servers, the energy costs to run them, the
Got
facilities.
it. And how does that compare to, say, Oracle's other business, their traditional software and cloud stuff?
Well, that's the kicker. Oracle's usual gross margins. For the rest of their business, they're consistently up around 70%. 70.
70% down
Yeah.
to 14. Okay. Now I see why the source called it a massive financial challenge. That's quite a drop.
A huge difference.
Yeah.
And the reaction. It was immediate. It was brutal. ORCL shares, they dropped as much as 7.1% during the day. They recovered a bit by the close, but still.
Ow.
And importantly, this wasn't just, an Oracle problem. You saw other big tech and AI names get softer too. Traders immediately saw this and thought, maybe there are wider profitability doubts across this whole AI infrastructure space.
So this one number, this 14%, it matters because it just punches a hole in that easy profit assumption, right?
Yeah.
It suggests either the costs are way higher than anyone modeled, or
Or they don't have the pricing power everyone assumed they would in such a hot market. High costs or low prices, either way, it's a problem for that narrative. And this report, I mean, it really landed like a splash of cold water. It just completely overshadowed what had been this incredible, really bullish run for Oracle stock.
yeah, you have to remember the context. Coming into that week, Oracle shares were up nearly 70% for the year, just flying high purely on these huge AI expectations.
And they had some big numbers fueling that excitement, at least on the top line.
Yeah.
That cloud contract backlog had hit, what was it, $455 billion.
$455 billion in contracted revenue as of August. That's not just growth. That's like a 359% jump year over year. I mean, that number just screams future demand. Insane scale.
And then, of course, the big one, the partnership that really cemented them as an AI player in people's minds. That huge deal with OpenAI, reports were like $300 billion over 5 years
Yeah.
for cloud services.
So you see $455 billion backlog, $300 billion OpenAI deal.
Right.
You're definitely not thinking the margin on that business is going to be 14%.
Not at all. And yet that 14% figure just instantly wiped out all that positive feeling.
We even saw it technically in the charts, right? Oracle stock dipped below its 21-day moving average, first time since that big rally started back in early September. For chart watchers, that's a clear sign, momentum broken by this one margin number. Okay, so once the dust settled a bit, Wall Street seemed to split into like two main camps on
Yeah.
this. And this is where it gets interesting for sorting things out. Let's start with the defenders, the optimists. What were they saying? How did they justify the 14%?
Right. Their argument basically came down to two things, scaling and lag.
Yeah.
So you had analysts like Brad Reback at Stifel. He argued that, look, margins will get better as this whole segment scales up. Apparently, he was already forecasting something like 16% gross margins anyway, so 14% wasn't a total shock to him. The idea is just that when you start out, these subscale GPU workloads, they just cost more per unit. You're building the factory before you have all the orders filled, basically.
But hang on, if they have a $455 billion backlog, aren't they supposed to be scaling already? I mean, does the lag argument just sound like an excuse for things taking longer?
Well, that's exactly the point the skeptics raise. But the optimist view, guys like John DiFucci at Guggenheim, they talk about the capital cycle lag. He argues there's this unavoidable delay. Oracle has to spend huge amounts of money now to build the data centers.
Right.
Massive capital expenditure.
Right, buying all those Nvidia chips.
Exactly. Incredibly expensive assets. They start depreciating, costing money the second they're installed. But the revenue from the customer using them, that gets recognized over the life of the contract, maybe 5 years. So there's a mismatch in timing.
Ah, okay. So under that view, the 14% is just a snapshot in time, heavily weighted by upfront costs. They think these deals will eventually average out higher, maybe like 25% gross margin over the whole contract.
That's the belief.
Yeah.
Yeah, they argue Oracle wouldn't lock in these long-term deals if they didn't project, decent profitability over the lifetime. It's about when the costs hit versus when the revenue flows.
Okay, that's the glass half full take. Now what about the other side? The caution, the pessimism. Why did other analysts see 14% as just a fundamental red flag regardless of scaling?
Well, because a lot of investors weren't just betting on growth. They were betting on highly profitable growth from AI. They saw it as replacing Oracle's slower traditional business with something new and high multiple.
Right, something that justifies a much higher stock price.
Exactly. So when the flagship AI business comes in at only 14% margin, even with scorching demand, it just changes the whole investment story.
Yeah.
The big risk here is this mismatch. You keep getting high revenue growth, sure, but the margin growth just doesn't follow.
And that kills investor confidence.
Instantly. And it leads directly to lower valuation multiples for the stock. People won't pay as much for growth if it's not profitable growth.
That trust issue seems key. If the whole story relies on future high margins and you deliver low ones now, the valuation model kind of falls apart. It's worth pointing out Oracle didn't comment on the report itself, did they? But we might hear more soon.
That's right, they declined to comment. But they are hosting an Analyst Day next week. It's part of their big AI World Conference in Las Vegas. You can bet that event is now completely dominated by this margin question.
Yeah, management's going to be under the microscope. They'll have to explain how they get from 14% towards that, 70% investors are used to.
Intense pressure, for sure.
Okay, let's pull back and synthesize this. We've gone through the numbers, the reaction, the arguments. What does this deep dive really mean for you, trying to make sense of this whole huge AI investment landscape? Let's do the good, the bad, and the ugly.
Okay, let's start with the good.
Sure.
And I think the good part is actually the market reaction itself. It shows that investors, despite all the AI hype, they are still looking at profitability.
Right, fundamentals still matter.
They do.
Yeah.
High growth isn't enough on its own. This kind of reaction helps reset expectations, maybe grounds things a little bit more in reality. It shows that AI infrastructure isn't just some guaranteed path to easy money.
Okay, fair enough. So what's the bad? Where's the real risk here, especially for Oracle?
The risk, I think, is really about execution and competition. Look, this AI cloud business is still pretty new for them, relatively speaking, so maybe there is some overreaction in the stock drop. But the challenge is real. They have to manage these huge scaling costs, the sheer amount of capital needed for data centers, and do it efficiently. And they have to do that while fighting the giants, AWS, Azure, Google Cloud.
Who already have massive scale.
Yeah, exactly. They have scale, they have buying power. If Oracle can't get its costs under control or execute flawlessly, that competition is just going to squeeze those margins even more. That's the bad scenario.
Okay. And finally, the ugly. If it turns out that 14% isn't just a temporary dip, if that's closer to the reality of this business, what's the ugliest implication?
If that 14% margin sticks around, the ugly truth is it suggests Oracle might genuinely lack pricing power, even in this red-hot market for AI servers.
Meaning they can't charge a premium.
Right. Pricing power means customers have to pay up because your service is essential or unique. If Oracle's basically just competing on price to fill up these expensive new data centers they're building, well, then they're just selling a commodity. The chips are the value, not necessarily Oracle's service layer on top.
And being a commodity provider is not where you want to be for high stock multiples.
Definitely not. That's not a path to long-term high-value growth. That's the ugly possibility.
So it really brings us back to this core tension we started with. You've got this massive, undeniable demand for AI services. That $455 billion backlog proves it. Huge demand.
Unprecedented demand.
But it's running smack into this harsh reality of infrastructure profitability, symbolized by that surprise 14% margin. The cost is just enormous.
It really is the ultimate check on all the exuberance around the AI boom. And it puts the focus squarely on a tough question. How will Oracle, or frankly any of these providers, actually fund the sheer amount of data center capacity needed to meet that demand profitably?
Yeah.
Which leads to the final thought, something for you to really chew on. How sustainable is this whole AI infrastructure build-out if the main financial challenge isn't winning the contracts anymore, but actually affording and profiting from the chips and the data centers needed to fulfill them?
Something to definitely keep in mind as you watch this space and the next wave of earnings reports. That's all for this deep dive.